And welcome back. The Fed is actually scheduled potentially to start cutting interest rates in about 3 weeks, which is our next meeting scheduled on September 18th. So in today's video, we're going to talk about how this could impact our housing market and also mortgage rates as well. And I'm joined by Jim Black, the man, the myth, the legend. Welcome back, Jim.
Thanks, Jason. Good to see you. I saw you, I think last week somewhere. Was it in Michigan we were for 3 nights?
Yeah, I think I might have saw you in Detroit. Yeah.
Yeah. We were in Detroit for a really cool industry event, some great leaders. And it was awesome to meet leaders of one of the largest mortgage companies in the country. And really cool to see Detroit revitalized by a lot of good investment made by some key people. So
Absolutely. I mean, if you haven't been to Detroit lately, I mean, I've never been to Detroit. First time last week. Absolutely beautiful city. Amazingly clean. I could not believe it. But today's video is about what the Fed potentially start cutting interest rates in about 3 weeks from the time we're making this video. And I really want to make this video to kind of talk about how that could impact our housing market and also talk about the correlation between the federal funds rate, which is the rate the Fed controls, how that impacts mortgage rates. So Jim's been a licensed loan officer for about 22 years. So I thought it'd be great to have you on the channel and kind of talk about that.
Thank you so much. I'm really glad I'm here. And what's really important to think about with interest rates is there's no direct correlation between what the Fed does and what long-term mortgage rates do. So one of the big things we hear a lot is sometimes people say, oh, rates are dropping by a quarter. That means my interest rate's going to drop by 0.25%. It could be more or less. It's kind of crazy. It's like I get that call all the time. And it's just been interesting to, in my 22-year career, sometimes people don't realize it's the sentiment of what the markets believe is going to happen is where interest rates end up.
Absolutely. So this is a very important thing to kind of take away. If you don't take anything away from this video, this is the most important one. The rates we have today, daily rates, in the mid sixes approximately, those are already baked into the fact that most people in the street is forecasting and predicting and expecting that the Fed will start cutting interest rates in about 3 weeks. So don't think that once the Fed starts cutting rates, that will decrease rates that day. That's simply not true because the street is already forecasting that the Fed's going to start decreasing rates, and therefore rates have already gone down based on that expectation. Anything you want to add regarding that, Jim?
Yeah, basically it's sentiment. It's the markets. Financial markets are always forecasting what the Fed's going to do and the likelihood of them doing something. And that confidence factor is what really dictates if something's going to be going higher or lower. So for example, when rates go lower, that means that the markets like interest rate cuts because it means that the cost to borrow or the cost to invest is lower. So that's a good thing. That makes the market feel healthier. If rates go higher, it means that there's inflation or that they need to slow down the economy. When you slow down the economy, that means that the stock market normally peters out. So you have an interesting time right now where you have Wall Street cheering the rates being lowered with the Fed wanting to make sure that they do it appropriately, not to create more inflation, which could then create a bigger issue down the road.
Yeah, right. Yeah, the Fed has basically this dual mandate, maximum employment and, minimize price increases. In other words, kind of like a level 2% range for inflation. Obviously, for past, couple of years now, maybe a few years, we've had elevated inflation, but it's been winding down. And also we're seeing kind of our labor market slowing down as well. So they have this kind of balancing act between, making sure we have maximum employment and also kind of inflation in check as well.
Exactly right. And again, what's great, what is directly benefited from an interest rate reduction? Those things are student loans, car loans, short-term loans, home equity lines of credit, anything that has a variability on a short-term index. Those are all benefited directly. If rates go down a quarter, your line of credit for your home equity loan should also go down a quarter. Some banks put in floors, which means they put in a bottom that the rate can get to. So you want to check your note to make sure that that rate will adjust below current rates. Some credit cards should be going lower. If the cost for a bank or an institution to borrow money goes down, you should see some relief also. So it should help everyone out on a short-term, month-to-month cash flow basis.
Right. And that's basically happens just like this for those accounts that Jim mentions, but not for mortgage rates entirely different. So having said that, the Fed controls the federal funds rate, which is the overnight rate that banks charge each other to lend each other money based on reserve requirements. But what exactly, what should we be looking at in order to kind of gauge the direction of mortgage rates? Anything that,
Yeah, there's a few things that you want to look at. Labor numbers, make sure that labor jobs look good. Consumer confidence is important in those elements. And remember that the Fed operates separately than the bond market. The bond market is dictated off of what I would say a flight to quality. So if there are unknowns and uncertainties in financial markets or other countries or parts of the world, people choose to have a flight to quality. Quality being something that has a secured asset behind it, not a piece of paper, not a Bitcoin, none of those things, but a physical asset, right? That's the best secured investment you can make, is a secured asset. So you see people flight to quality. They go from being in the stock markets to something that's secured. As people fight for those securities, it's a reverse mindset. The bond price, or I should say loan rate, goes lower, because if you and I are competing for $1 million note, which would be nice one day, I may take 0.01% less than you to get that. So it's a reverse auction, basically. So the bond market works reverse. So again, if there's a lot of people wanting mortgages and there's only a certain amount of mortgages, people are going to take a little bit less to secure that long-term return that's secured on a mortgage note.
Yeah.
The opposite is true when there's too much or a flooding of mortgage notes in the marketplace. If there's extra notes outstanding, I want more money or more return. So rates will go higher until the investor is satisfied with the level of return and the demand is equal to the supply.
Yeah.
So you have to look at it that way, if that makes sense.
Yeah, absolutely. I think that basically an inverse relationship, right? When the prices go up, the yield goes down. Just like anything, if there's like a high demand for cars, for example, and there's not enough supply, the price goes up. And of course, well, maybe that's a bad analogy because we're talking about yields, but the demand for anything, prices go up and then the yield goes down. So in an environment in which we have, the bond prices going up, then yields go down and therefore rates go down as well. So any forecasts regarding, what do you think is going to happen regarding mortgage rates for the rest of the year? Or is that something you kind of don't really focus on because it's kind of a little out of our control?
Great question. I look in like 6-month increments. I've never really explained this. I look at kind of a half yearly cycle to see where the trend's going. I do that because of 2 reasons. Number one, I want people to make good decisions today for the long run, knowing that if something down the road was to happen, it's a blessing, it's a bonus. I don't want people today thinking tomorrow they can refinance. I want someone to be comfortable with their long-term plan. We also look at that 6-month mark because at that point in time, investors, for the most part, will let us use the current value of the property to look at optimal refinance strategies. So you have to make normally 6 payments or have your loan seasoned for about 7 months. So that way, if you've done improvements on your property or if the value continues to go higher, or unfortunately, if it goes lower, those are things that play a role in those decisions on your loan to value. So I like to look at that 6-month mark as kind of my window. And then back to our break-even analysis that we've talked about before on your channel, I like to make sure that break-even is less than like 18 months to 2 years.
For refinancing, you're saying?
For refinancing, exactly. Or even paying points. Because paying points on the purchase, right? I want it to be less than a 2-year period of time because you're most likely, I'm almost 100% confident in this, not going to keep that mortgage for 30 years. Something's going to happen. You're going to move. You're going to have something happen in a hopefully positive way, but also could happen in a negative way. Either way, that loan is most likely not going to make it to maturity. So looking that far out is just too far. If the break even was like 25 years, it doesn't make sense. So we want to look at that shorter term horizon. 6 months is my forecast for rates. I do believe rates are going to go lower. I think we'll be in the low mid 5s to high 5s by the end of the year. During election years also, the government doesn't want to have influence. The Federal Reserve is not elected by the outgoing president, so we don't want to have any influence there. So they just try to stabilize the market and make things kind of in a status quo place. You're not going to see anything dramatic happen in the markets because that would skew the voting to one side or the other, depending on the positive or negative impressions that current economic situation led to.
Interesting. Yeah. I don't think there's going to be wild fluctuations unless like unemployment spikes, for example, or if inflation starts winding up again, which I don't foresee that happening. But there's so many things that impact our market that makes it very challenging to kind of predict what's going to happen. But yeah, I agree that overall, if we kind of in this downturn regarding inflation, we'll probably see rates decrease further. Giving people more opportunities to buy houses. So that's all good things.
Yeah, absolutely perfect. And now you're also seeing what's really important to understand as a buyer, seller 2-1 buy downs are still very, very valuable to look at. What a seller 2-1 buy down means is you're buying the rate down temporarily, 2% below your note rate the first year and 1% the second year, knowing that even if you refinance, you still get that difference in savings as a principal reduction. So seller 2-1 buy downs or buy downs are still a very valuable thing because you do get the benefit no matter what. Don't be worried of getting big credits. Those credits are always good to be using for other things. We can use credits for a property tax and insurance impound account. We can use them for paying buyer commissions. There's all kinds of ways to structure those things.
Yeah, the 2-1 buy down too, the seller has to pay for that fee, correct too?
Yes, there are ways to structure that. We have a myriad of different ways to do that. It can be buyer or seller finance, correct?
Yeah, and also something that's really important to know about 2-1 buy downs as well, compared to like 2008, for example, is that the lender, for example, let's say Revest Loans, they qualify you based on your payment on year 2. So when the rate moves
year
to
3, year 3, year 3.
3, sorry, yeah, exactly. So you're, let's just say 6% is the current rate. Your first year, it's going to be at what 4%. Next year at 5%, year 3 at 6%, and you're qualifying you based on the 6% rate, not the 4% rate. Much different compared to the qualification process back in 08. Let's just say that.
Absolutely. Yep. So we got some exciting things ahead. The market feels good. The buyers are coming back. There's more confidence. There's an anchoring effect, like we talked about before in your channel also, where people are not willing to move because the interest rate differential is so extreme, right? I own a house down here at 3%, rates are at 7%. I'm less likely to move because I'm financially going to be worse off in the long run. As rates get closer to that equilibrium, you'll see more people more likely to move because they know that their payment will be similar to their previous payment. They may be moving up or down, but they're still having a similar cost to interest. And once that happens, I think you'll see a lot more fluidity in the marketplace or more velocity with people wanting to sell.
Yeah, and we have a lack of that happening really in California. I just actually posted a video yesterday about this. New listings are down by like about 30% from 2019. So even though they're up by 20% from a year ago, we're still down way down compared to pre-COVID levels. And that's because of this anchoring effect. People have rates, just like you mentioned, way below current rates. But if rates were to decrease to get people off the fence, you might see more options as well, which of course potentially could increase inventory as well, which would be a good thing for home buyers out there as well.
Yeah, and we have a really cool tool also to reach out to Jason and I. Our blended rate tool are also the break-even tool. Again, get knowledge, be in front of your knowledge. We have probably 5 mutual clients together that are ready, geared up, queued up. They've given us all the documentation. They're ready to go. Once that rate gets to the level that they're at, I can lock them in, and then we're ready to go. So we're not having to stall and figure out things later. We're prepared. So get prepared early. It costs nothing to be prepared to refinance. It costs nothing to be ready to go. 2 weeks ago, we saw rates drop about 3/8 in one day.
That was crazy.
3 days later, they were back up to where they were previously. I was able to lock 7 people that day. 7 people are very happy with me. Some people that didn't have their stuff prepared, we couldn't get a lock done because they hadn't given me their application. So be prepared, and there's no cost to be prepared. A lot of times we don't even have to pull a hard credit pull either to be prepared. So
no, that's a really good point. I mean, there was that one day, which I remember was a Friday, probably like 3 weeks ago. And that was like the time to do it.
Yeah. Friday to Monday. Monday morning is when it was the lowest.
Yeah, right. Exactly. That was like almost a 1.5 a year low. And if you're not in the queue, you don't have all your documents with your lender, then you can't move that quick. And same goes on the sales side as well. You find a home you absolutely love. It's like Sunday, and then you find out they're looking at offers Sunday night, and you haven't even gotten pre-qualified. I mean, people, do your homework, get in a position to move if you guys are even thinking about doing it, because just like you mentioned, it doesn't cost you any money. So
you and I last night were working until 10:30, sending out scenarios to 2 clients. So your partners are your professional real estate professional and your lending partner. They should be working hand in hand. Most of them won't have relationships like Jason and I for 20, 30, 40 years, but just know you have to be in sync, because you want to strike when the opportunity's there. And if rates drop and there's a house in the market you like, you wait a couple of days, more buyers are going to want to write an offer on it, because they finally realize that the cost just went down from them to buy. So you really got to be on top of your game, be in front of these things, and make your own decisions. The Fed has their decisions. You have your own personal decisions on your life and what's important to you. We'd love to be a resource for you there. And yeah, that's all I got to really say.
Awesome. Thanks, Jimmy. Appreciate you so much. Friends, good friends for, 35 years, I think it is. It's absolutely crazy. It's so fun to be working together. I just can't get over it. So awesome, man. I appreciate it, buddy. And everyone watching today's video, we appreciate you as well. Please like and subscribe, and we'll see you in the next video. Have an amazing day.